Thank you, Susan. So let's go. Who will benefit from this presentation? Managers who have previously struggled at promoting rolling financial forecast as an advance to the annual budgeting process. Managers who intend to champion driver-based budgeting and rolling financial forecasts, and they need a compelling call to action. And the reason I have champion in quotation marks is because it's just been my observation that although it's nice for senior executives to sponsor and advocate innovation and new methods, often they are preoccupied with firefighting and short-term priorities. So it's typically managers 1, 2, 3 levels down the organization chart who kind of have passion or fire in the belly and ask themselves, how long do I want my organization to continue to perpetuate using stale or arcane or out-of-date methods? And they're the ones that'll do a proof of concept or a pilot project to demonstrate to their colleagues, co-workers, executives, even the board of directors, this is the way to go. So if you're 3 levels down in the org chart, that's fine. I like presenting to you. So my agenda, I'm going to have to start with a primer on cost accounting because it's foundational when we do the predictive view through the windshield as opposed to the historical view. Then after about 20 minutes of the primer, I'll get into budgeting, what's broken with budgeting, and the shift to rolling financial forecasts. As we conclude the presentation, we're going to have to put our industrial engineering hats on. I always like to say I'm an engineer masquerading as an accountant. I may have been in accounting since age 27, but I'm always going to be an engineer. And then at the end, something that frustrates me, why is the buy-in, why is the adoption rate to these methods so slow? I like to start with this cartoon, drowning in data, but starving for information. You have this poor beleaguered clerk, shoulders hunched, stad, paper all around him, and the supervisor in the doorway to the left is asking him, looks like you've got all the data. What's the holdup? You know, I gave you the request this morning. How come you don't have the answer this afternoon? And the message here, there's a difference between data and information. Data tends to be transactional, collected in business systems, but you convert the data into information to get those insights to support better decisions. I also like to start with these 3 questions. What, so what, then what? So imagine that your organization implement some of the methods I'm going to be describing here. I say celebrate for 1 day. Your organization will see much more information that they've ever seen before. Some of it will be contrary to their belief system. So that begs the second question, so what? What's relevant? But arguably the most important question is the third question, because all decisions only impact the future, the then what, and that will be the theme of this predictive view. So let's start with the primer on cost accounting. What I'm showing you here from left to right spectrum is that ideally all costs should be directly charged. But as the variety, complexity, and technology increases, more and more costs are indirect and shared. Now, the highest form of direct costing to the left is project accounting or work order costing. But that only applies when you basically have something unique, like a make to order, engineer to order, or building a satellite as an example. In the middle is standard cost accounting. That's pretty traditional. And incidentally, this will not only be about manufacturing. All these methods, because the majority of employees, in fact, I think I read that out of 100 employees in the United States, only 8 make products. The other 92 do not. So all of this is universal for service organizations, banks, insurance companies, travel agencies, and also, and I don't have a slide here in it, government. I do have co-authored a book called Value-Based Management in Government. If you look it up in Wiley, you'll be able to see it. All of the methods that apply for commercial organizations also converge and apply to public sector government. As we return to the slides, ABC, Activity-Based Costing and Management, I kind of call it the poor person's standard costing system. You'll see that it's actually simpler and easier to basically do the ABC. The real message to this slide is to the right, allocations. They're bad. Cost allocations. Most managers get upset when they have this, if you will, overhead that's allocated to their department when they didn't cause it. I'll talk about that in a few minutes. And what we are then doing is we're assigning all of these costs from the expenses into outputs, process, products, services, and so forth. So I now need to give a simple definition of ABC. Imagine you go to a restaurant with 3 other friends. You order a little salad, and the other order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, "Hey, let's split this check evenly." How do you feel? Not fair, not equitable. Well, that's how products or standard service lines also feel when the accountants take this large amount of indirect and shared expense, commonly called overhead, and they allocate it like spreading butter across bread to the products and services using these factors like number of labor hours or number of units produced or number of services delivered or square feet, square meters, number of employees in cost centers, head count. None of those factors reflect the unique consumption that those products and services consume of the end-to-end business processes and the work activities that belong to them, which in turn consume the expenses. So if you were to actually decompose those indirect overhead into what we call cost pools and trace and assign them with a cause and effect relationship, causality principle, really critical, you will discover, compared to that traditional butter spreading, in reality, some of the products and services are overcosted and some of them are undercosted. Must be undercosted because it's a zero-sum error game. That means the CFO and the accountants are providing flawed and misleading information to their managers. Oh, yes, it reconciles exactly for the external financial reporting, but it is wrong with the parts. So the simple definition of ABC is, it's as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. Now, the reason there's been interest in ABC over the last 60, 70 years has to do with this diagram. It has the 3 universal components of any organization's expense cost structure. The direct recurring labor at the bottom, and I use recurring again because service organizations say, well, direct, this is about manufacturing. No, it's service organizations, but it's the repeatable work, the material, and then that overhead. And you can see what's happening over time is the indirect is displacing the direct. And when you ask people why, they'll say, well, automation, hard computers, robots, we're kind of automating out the frontline workers. That is secondary. The main reason about this displacement is over time, all organizations have had an increased proliferation of different types of products or services. Companies, manufacturers, more colors, more sizes, more ranges, service organizations, insurance companies, more types of policies, banks, more types of depository accounts. The point is this: as you basically increase the diversity and variation of the outputs, it just produces complexity. And complexity causes the need for more and more indirect expense to manage it. So 50, 60 years ago to the left, when the indirect was relatively small, okay, you could butter spread it because the majority of the expenses were direct and accurate. That's not the case today to the right. It's much larger. So we have to apply these activity-based costing principles. Now, the primary view of managers is they basically get, I'll show you a cost center statement, but we really don't know what the end-to-end process costs are, the activities, or with any accuracy to the outputs. ABC solves that. Now, the problem actually begins with this traditional responsibility cost center statement. Every manager on the planet Earth recognizes this statement: salary, equipment, travel, and so forth. But the problem is, when you ask managers who receive this report, how much insight and understanding do you get about the cost that you can influence and control, or where it goes? They basically say, I don't know. Notice at the bottom, I say, when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. Activity-based costing makes them smarter. And here's how. Notice what we've done is we've converted the exact same 914,000 in the cost center statement into the middle, the language of work: key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And then we reassign those activity costs into the products, services, or customers, just like the waiter or waitress in the restaurant. Now, when organizations actually experience ABC, they get an aha moment. They usually traditionally think that the expenses begin at the left. After ABC, they discover, no, the expenses actually begin at the right side of this diagram. Products, services, and customers place demands on the workload in the middle, and the workload draws on the spending or the capacity on the right, and then the costs measure the effect in the opposite direction. So that is, again, demands on work flow right to left, costs measure effect left to right. It's a principle. Rules are many, but principles are few. Principles like speed of light or gravity. You can't violate those, but the CFOs and accountants do violate it when they do that butter spreading. Now, I've rotated the previous diagram 90 degrees to the left. It's not as simple as, oh, you just take these ledger expenses, convert them to the work activities, and then assign them to the cost objects. The right diagram is far more realistic because you've got support departments that support other support departments that ultimately support the frontline departments that interact with customers or make products or deliver services. So it must be a multiple stage cost assignment network. And incidentally, I know most of you are from the IT function. In fact, I'm so happy you are here. Most of my presentations to our accountants with CPA firms or state CPA societies, and the accountants are in the 1960s. You know, we got to get them into the 21st century. So you may, after you listen to this webinar, you may want to have the accountants in your organizations. It's archived with this web producer, you know, to watch and learn from this. Now, this is a more complex, if you will, decomposition of the previous diagram. I'm going to go through it quickly, but in another slide, I'm going to show you a link to where there's a 30-page document that will go through it more slowly. But let me describe it to you. It's got the three universal components of any organization's expense and cost structure. You've got the expenses at the top, salary, material, and so forth. You've got the work activities in the middle, and they eventually pile up into the bottom, into the products, services, customers, and something we call business sustaining. Now, you need to adjust your thinking here. This is not a process flow chart with swim lanes. It's a reassignment network. So, for example, if the organization spent $2 million in January, it will have the exact same $2 million of work activities in the middle, and they will pile up that same $2 million to the penny into the bottom two right boxes, customers and something called business sustaining. All of those arrows, think of those as thin straws or wide pipes, where the diameter of the arrow reflects the money flowing through. That's why it reconciles exactly. In the middle, you'll notice we've got people activities and equipment activities. Men and women run machines in a factory, machines make products. Men and women drive buses, buses deliver passengers. So assets, equipments also do activities. You know, the point here is this: costing is modeling. It is not T accounts and journal entries, which is what the accountants do. Direct costs, not broken. You may have data integrity issues with your direct costs, but that can be fixed. Again, because I went through that so quickly, if you want to take the time to read much more about it, I did author an article, a statement of management accounting for the Institute of Management Accountants. I've been a member of the IMA, plus many other organizations, professional societies. I've been a member for 30 years. In fact, for 3 years, I was there after I retired, voluntary, unpaid executive in residence. If you click on that website at the bottom, 30 pages, it'll describe the previous two slides. Now, what's more important, what's the result when you basically do ABC? So what this chart is showing is the horizontal line would be that traditional butter spreading overhead, you know, labor hours and so forth. The vertical axis is the magnitude of the error when you do ABC, and ABC is the squiggly line. And what you'll notice is to the left, you will discover that the simpler products, they're going to be like you in the restaurant, you know, have actually been overcosted. They're really hidden profit. And to the far right, as we go up, that's really the more complex products. That's those three others in the restaurant, you know, who order the expensive meal. They've been undercosted, so you're actually losing money. And the magnitude of error compared to the traditional allocations is not like 4 or 5%. It can be 30, 40, 50%. And this is important because you'll notice for the ones on the left, the competitors, who may have more accurate information, they may price their product 5% less than your price. So they're basically grabbing market share from you. And to the right side, what happens is the sales force who thinks the products are profitable, they're in reality unprofitable. They're selling more and more and more unprofitable products. So the more they sell, the lower your profitability of the company. This slide is far more, if you will, demonstrates the impact. And this is a real graph from a real company. The vertical axis is the net revenues minus the properly calculated ABC cost that I just previously showed you. The horizontal axis is the cumulative buildup of the profit, but it is rank ordered starting with the most profitable product to the second most profitable product and so forth. The last data point to the right will exactly reconcile with the income statement of the company. Now, this company, and this incidentally is one of my very first ABC implementations, like 1988 with KPMG. It had 30 million in quarterly revenues, sales, 28 at expenses to net out at 2. But the top line always provides shock to the executive team because it really demonstrates the unrealized profit revealed from ABC. So in this particular case, the company had roughly $8 million of unrealized profit on 3/4 of their most profitable products. They lost $6 million on the remainder to net out at 2. But the belief system before ABC was this blue line. Oh yeah, we have a few little unprofitable products, not the magnitude. Some of you may be saying, well, what do you do with all those unprofitable products to the right? Do you drop or abandon them? No, that could be a mistake because some organizations deliberately will sell some products, if you will, below their cost because they are paired with more profitable products. Blades and razors is an example. You sell the razor at a loss, but you make up the money with the razors. Also, accounting does a terrible job with life cycle costing. It's basically period costing, January, February. So in this particular case, if a new product has just been released, it could basically be in a shakeout period, extra work, no sales volume yet. So it'll be unprofitable. But each time you refresh the model quarterly, maybe even monthly, it will migrate to the left. But the point is this: costing is modeling. Now, if you remember anything from this, here's another point. In the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. The problem is, the executives, they may basically rely on that blue line, so, they're basically relying on intuition, flawed information. So we got to get to reality. Some of you may be asking, gee, I think we should be doing this ABC at our organization. However, you're same suspicions as the accountants. Oh, it'd be a mudslide of data. Every employee would have to fill out a timesheet. And employees hate timesheets. There'd be 3,000 activities in that system. And then the IT department would have to basically extract driver quantities for all 1,000 and on and on and on. Well, sadly, that was the belief in the last several decades. And as a result, the models were way too large, way too complex. They collapsed under their own weight. They were unmaintainable. No one could understand them. And so then people said, oh, ABC doesn't work. No, ABC works. It's just full absorption costing done correctly. And I was fortunate to come up with a method over 2 decades ago called rapid prototyping with iterative remodeling. It starts with 0, a 2-day workshop. You bring in 5 or 6 cross-functional employees into a room. You quickly build a high-level ABC model. Its purpose is not to have any useful information. It's so that on the second day, bring in the other line managers, the executives, maybe even board of directors. They see it. It's very engaging because it's their own company, and the light bulbs go on with everybody. Oh, that's how we get rid of that butter spreading. Oh, that's how we can see our true profit margins. Oh, that's how we could actually see customer profitability. Oh, that's how we could do benchmarking with apples and apples, not apples to Oreos. So you do 2-3 more iterations within 2 to 3 weeks, you will have a permanent repeatable production system. Notice at the bottom, I say, make your mistakes early and often, not later when the system is too hard to change. Why does rapid prototyping work? It has to do with this diagram. The vertical axis is the accuracy of a cost object like a product or service line. The horizontal axis is the administrative effort to collect the data, validate the data, calculate the data, report the data. You'll notice you always get an asymptotic curve, which means the accuracy goes up relatively quickly, and then it levels off at that elbow to diminishing returns on extra accuracy for the extra level of effort of work. And so with the ABC method for management accounting, it's good enough. Stop at 95% accuracy. It's good. This is not external financial reporting. I always tell the accountants, you get the external statutory reporting wrong, you go to jail. But if you get the management accounting wrong, you don't go to jail, so ease up, right size the model. And that's what the iterations do. Notice I say, is the higher climb worth the better view? Benefits from rapid prototyping. Accelerated learning. People get it. They understand it. It solves that thorny leveling problem. Or they're going to have 2,000 activity, 3,000. They typically level off at about 50 to 70 activities. It prevents that over-engineering, which gave ABC the bad reputation from the past. Also, peer group, predetermining uses of the information. When I conduct these workshops on that second day and the line manager of the room, I say, let's go around each of you. When this system is implemented in 3 weeks, how will you use it? What decisions will you make? You, I'll do margin analysis. I'll do benchmarking. It basically makes sure that they're going to use the information once it's produced. It replaces misconceptions with reality. I love this cartoon. You may want to show this to your CFO. It's got this signboard. And to the left, simple but wrong. To the right, complex but right. Look how few are taking the right path. Most of the CFOs are taking that left path. I'm just going to allocate the overhead on labor hours or units produced. It's simple, but it's wrong. And notice some of them are falling off the cliff, going bankrupt. That may explain why some of the big vendors like Toys R Us, Blockbuster went bankrupt. They had flawed and misleading data. So this topic, now the next 60 minutes, we'll talk about budgeting. What's broken with budgeting? The budget is typically a fiscal exercise done by the accountants that has two problems. It's disconnected from the executive team strategy, and it's not based on future driver volumes. It's not volume sensitive, if you will. In a few minutes, you're going to understand why I walked you through the first 20 minutes on the activity-based costing, because it's foundational in order to do the predictive view. You may laugh at some of this. This is not a polling question. See how many of these boxes you would check at your organization. Our annual budgeting exercise is invasive and time-consuming with few benefits. Takes 6 months from beginning to end. You start in June to basically publish it the next January. It requires 2 or more executive tweaks at the end. So when you publish it, the executives don't like it, go change some of the numbers, get it right. It's obsolete in a couple of months after we publish it due to events and reorganizations. It starves the departments with truly valid needs. Maybe in the next fiscal year, there's going to be a shift of workload towards your department, but you didn't give them additional headcount or enough additional headcount. It caves into the loudest voice and political muscle. That's from the bald head guys, the gray hairs, the men and women that are 50 years or older. They're the sandbaggers, the veteran sandbaggers. They know how to basically pad that budget. It incorporates last year's inefficiencies into this year's budget. So the processes were inefficient last year, and we're just replicating going forward into the next fiscal year. This last one's the one that bothers me the most. It's over because when a manager is on a glide path, 3 or 4 months away from the end of the fiscal year, and it appears to them that they're not going to have spent all of the budget that was allotted and approved for them, what do they start doing? They start spending needlessly, foolishly. Why? Because they know that their next year's budget is going to be pegged to a baseline of how much they spent this year. I kind of call it spreadsheet budgeting. I'll show you that in a second. Refer to it as use it or lose it spending. And here's a quick testimonial about this from a friend of mine who sent me an email. I'm going to quickly read through it. My son is currently a logistics officer in the U.S. Navy. He is responsible for the budget and every item that comes onto his ship. He is frustrated with how the military operates. For instance, in August and September, he had to spend every dollar that was budgeted for the year, because if the total budget isn't spent, then that amount is not appropriated the next year. So the consequences are he has to buy items not needed and that they already have multiples of it and stored in a warehouse never to be used. He says the commanders don't understand that each year is different, and depending on the circumstances, different amounts of budgeted money are needed. He is frustrated as to why his commanders operate in such a wasteful way. He says when it is brought up, the reply is, "This is how we do it." So he says nothing will change until all the older officers die off. That will take decades, and he doesn't see it changing. This demonstrates how frustrating it is to someone who went to college, has a business degree, understands the business. He is so frustrated he wants to quit the insanity of how they operate. In my dealings with federal, state, and local government as a consultant, that is how all of government works. It is a wasteful spending of our tax dollars. It seems to be a hopeless cause. Well, before I show the next slide, let me describe how I believe you probably have budgeting in your organization. The accountants give every cost center manager a spreadsheet, January to December, with all of the line items of their expense accounts, including rubber bands and paper clips. They fill it out. Someone in the accounting department then consolidates all of the spreadsheets. They bring in the forecast of the revenue from the marketing and sales department. They give it to the executives. They say, not good enough, too much, not enough profit, change some of the numbers. You give all the spreadsheets back to the managers. They lower some of the expenses, back to the consolidation by the accountant, up to the executives. That's a little bit better, not good enough. Up, down, up, down, up, down, up, down. Come on. You almost want the executives to answer, what number did you want in the first place? That'd save us all of this basically up-down spreadsheets. But that would give us their aspiration, the executive's aspiration. We want to know reality, what can actually be achieved. And here's that traditional way that I described, for a cost center manager. They project to the end of the year for their department, let's say wages, 400,000. All right, for next year, we'll give them a 5% increase for inflation, column B times 1.05, copy down. I hope some of you are laughing. This is ridiculous. What if this department's going to have a substantial increase in workload next year? They'll be understaffed. You didn't give them enough money. Or if work is going away, like a bank, a branch bank, more of it's going to ATMs, than the clerks inside, they'll be overstaffed. So now let's talk about the shift to rolling financial forecast. You're going to need to think like an engineer here. Imagine that the amount of spending that is required in the future is the result of two river streams. The upper river stream is the recurring, repeatable expenses. Okay, it's going to be demand driven, typically customer demand if you're a commercial organization. Government, it could be demands coming from, demographic changes in school districts and the like. The lower river stream is the non-recurring, non-repeatable expenses, and that will come from projects that have beginnings to end. And in a few minutes, I'm going to describe 3 projects, but I'll tell you them right now. There's going to be strategy-related projects for achieving the strategy of the executives. There's going to be risk mitigation projects, and there's going to be capital projects. So let's talk about the upper river stream, the repeatable work. I already described to you historically, when we're looking through the rearview mirror, that's the activity-based costing. It's historical, it's descriptive. It starts with known spending, exactly to the penny or the euro, if any of you are attending from Europe, or any whatever currency from a foreign country. We have those driver quantities. We calculate the cost of products, services, channels, and customers. But for the predictive view to the right, going through the windshield, not through the rearview mirror, we basically, I'm just going to say, we calculate the model backwards. We forecast the volume and mix of the demand coming at us. We multiply them times unit level consumption rates. I'll describe this in the next few slides to solve for the level of spending and capacity. So remember this initial slide, the cost managers get those resources. That's those cost center, responsibility cost center statements. We try to calculate the end-to-end process costs and the activities that belong them to get to the products and services. But for the predictive view, we start at the bottom and we calculate backwards. So let me describe this again in a different way. To the left side, the spending is known. We calculate the work activities and the cost objects, but we pick up a bonus here. We get unit level cost consumption rate. What's the cost per material move in a factory? What's the cost of a bank loan, automobile bank loan? What's the cost per each type of policy and insurance company? Unit level cost consumption rates are key. And so we basically calculate backwards. Notice I have the equation to the left. I think I learned this my second semester freshman year at Cornell University Industrial Engineering. The equation is this: the demand, volume, and mix times the unit level cost consumption rate equals the capacity required. In other words, the number and type of employees with their associated wages and salaries, and purchases with suppliers or contractors. Now, that's the upper river stream. Now let's talk about the lower river stream, the non-repeatable, non-recurring work. And now I'm going to have to do a quick primer on one of those three, if you will, projects. It involves the strategy map and the balanced scorecard. So here's a quick primer. Some of you may be familiar with the balanced scorecard. It was created by Professor Kaplan, the same Harvard professor that taught me activity-based costing, but he also did the work with Dr. David Norton on balanced scorecards and strategy maps. Incidentally, the strategy map, which you're looking at right now, and I'll describe it in a second, is orders of magnitude more important than the balanced scorecard. The balanced scorecard is just a feedback mechanism. So here's the background. What Kaplan and Norton realized is executives were overreacting to financial results reported at the end of the period. They said, you need to shift your attention to non-financial metrics collected during the period so you can react to them. And they created this diagram that has 4 perspectives with cause and effect relationships from bottom to top. Each of the squares you see there are what are called strategic objectives. Oh, I may also add another reason Kaplan and Norton created this is because most executives are good at formulating strategy, but they fail at successfully implementing the strategy. And there's a fair amount of empirical evidence of this. There's a executive recruiting firm in Chicago, Challenger, Gray, and Christmas. They monitor the involuntary turnover of CEOs in North America, firings of CEOs. It is increasing every year. And I believe the reason is because board of directors post-Enron now take their job, their governance job, far more seriously than ceremonial, And a good example is Carly Fiorini at Hewlett-Packard. The board of directors gave her 5 years to implement HP strategy. She failed, they terminated her. So we need to basically align the behavior of employees and managers with the strategy, and also communicate the strategy to employees and managers in a way that they can understand it. Most managers don't really understand the strategy. In fact, in your organization, if I went in the hallway and randomly interviewed 15 employees and said, quick, can you articulate your executive team strategy? How many of them could do it well? Probably none. Well, they don't understand the strategy of the executives. How do we expect them to understand what they do each week, each month contributes to the strategy? So what you see here with these 4 perspectives, we start at the bottom, learning and growth and innovation. If the employees are accomplishing those, they'll contribute to the internal process improvement objectives. If they're accomplishing those, they'll contribute up to the customer retention loyalty objectives. If they're accomplishing those, they'll then contribute to the financial objectives. All of those arrows, those are KPIs, with key performance indicators, measures. You get what you measure. If you can't measure it, you can't manage it. If you can't manage it, you can't improve it. So when the metrics, the 2 to 3 KPIs, that's it, maximum for each objective, has targets set by the executives, that's their job, then, and you start holding employees accountable to meeting the targets, or maybe even the bonus or incentive system, you solve the problem of alignment. You're aligning them to successfully implement the strategy. So to summarize at the bottom, a learning environment will stimulate process excellence. Process excellence will lead to customer intimacy, and that will then create the financial value. Now, in each of the squares, each of those strategic objectives in the strategy map are really 4 components, which are the vertical columns. And what this diagram is showing is who is responsible for what, the executive team or the managers and employees. So we start with the strategic objectives. Yes, it's got to be the executives. That's their job. But notice the best way to implement this in the next column is to have the executive team delegate to the managers and employees the next step to identify what are the few and manageable projects that can be implemented or core processes to be improved. And then have the same managers identify the KPIs, because they're going to have to live with them. It'll give them buy-in. Now, when we get to the targets, notice we're back to the executives. And then the 5th column, I probably should have made it a row, because with computers, almost all the KPIs can be, if you will, extracted from the business systems. The message to this slide is, if we basically have the managers identify the projects and we fund them, then we've solved that problem that the budget of being disconnected from the strategy. We are now connecting it to the strategy. There's also some benefits to this delegation. It's also because now the managers will understand the strategy. Otherwise, they couldn't basically do their tasks. Remember the 15 employees in the hallway, So this is, and also if they've got bonuses tied to this thing, it'll help them basically achieve their bonuses. Next, risk assessment, enterprise risk management. The enterprise risk management uses this popular grid. Each of the circles is a risk event that could occur in the future. The diameter of the circle is how much money would be required to mitigate that event from occurring. The vertical axis is the severity of the impact of the risk event occurring, from low to high, very painful. The horizontal axis is the probability that the risk event will occur from low to high. Now, obviously, you can't spend money to mitigate all risks, but in the upper right corner, the blue shaded ones, let's basically fund the money for that risk mitigation. Now we're basically introducing risk mitigation into the annual budget. So let's revisit our 2 river streams. For the upper river stream, the solution is you do the modeling of your cost structure for the repeatable work. You do that forecast of the future volume and mix times the unit level consumption rates to solve for the level of spending, the capacity. For the bottom river stream, the non-recurring work, we have those 3 types of we have the 2 projects I just described, strategy projects, so that the strategy can be successfully executed for the executives, risk mitigation projects, and then capital projects. Everybody's familiar with capital projects, which I already mentioned. Now get prepared. I'm going to now decompose this slide into greater detail, but it's not as complicated as you think. The shaded boxes are the upper river stream, the repeatable work. The ones to the left that are not shaded are those, if you will, non-repeatable projects. So put your eyes in the bottom shaded box. It says derived budget in parentheses and rolling financial forecast. Notice what's going into it, the operational budget. But as we go up further, we basically start with the managerial accounting system. Here comes the unit level consumption rates. To the left, we've got the forecast volume and mix. That allows us to basically calculate the number of person hours, pounds, kilograms, number of employees. Basically, it's a capacity resource plan. Then we monetize it into a currency, euros, dollars. That's a pretty good number. Now, from the left, you can see we've got the capital budget, strategy budget, risk budget. I can tell you that if you do it this way, that number derived budget is going to be far superior than those spreadsheets. Remember the up, down, up, down, up, down, up, down spreadsheets? They were volume insensitive. And what's really good about this method is it not only can give you the budget out 12 months, but if you refresh this model, because the only independent variable in the diagram you're looking at is the forecast. Everything else has either been calibrated, like the unit level consumption rates, or derived from one of those strategy map, balance scorecard, and risk mitigation. So basically you can refresh that. And I will tell you why this is really more important in the last year or two, because then, and I know many of you are not accountants, but once you have a pro forma income statement and balance sheet, the next step in accounting is net cash flow. And that's actually what board of directors are seeking. They want to know if the company they've got governance responsibility is going to basically go bankrupt, or going to have to get loans or equity, or they may have surplus cash. Now, bottom right, see the diamond, acceptable. We're going to have a similar problem to the traditional budgeting. Remember when I said the executive tweaks by the executives on traditional budget? Even when this good number is produced, if they don't like the profit level there, they're going to say, go change some of the numbers. Well, one of the temptations might be, well, why don't we postpone or eliminate some of the capital budget spending? Why don't we postpone or eliminate some of the strategy project spending? Why don't we postpone or eliminate some of the risk mitigation spending? All bad. If we don't do the capital projects, then we're not going to do the investments that we determine. If we don't do the strategy projects, we're not going to execute the strategy. If we don't do the risk mitigation, we're going to be exposed to risk. So there is one lever in this diagram to lower that spending for the future. It's the driver consumption rates, the unit level consumption rates. And that's basically the message about productivity improvement in the processes. And this is there where the world of lean management, Six Sigma, the process improvement takes place. So that in the future, in the future year, the next year, we have 2%, 4%, 6% process improvement. I didn't mention to you that in the middle of my career, I was in Detroit with Deloitte. And I will tell you, and some of my clients were the automotives, General Motors, Chrysler, Toyota. And in that industry, they basically have price reductions with their suppliers, first tier, second tier suppliers, maybe 2-3% lower price each model year. Those second tier suppliers are really experienced at process improvement. They know they have to basically get that 2-3%, not only to basically lower the cost so they can maintain profit, but also more profit for the shareholders. So some concepts and definitions. The difference between a target, a forecast, and plans. Let's start with a target. A target is what we would like to happen, but which we achieve by producing a forecast. The forecast is what we think will happen. Now remember, this is what we think will happen. What plans are, because typically the forecast is going to have a gap between the target that is aspirational from the executives. And that's where plans come into play. Plans are what we intend to do to close the gap between our forecast and target to achieve the target. Now, forecasting. I love this cartoon. Don't treat forecasting as a special event. You got these three guys sitting at a table. The cartoon says, we haven't forecasted in a while. Maybe we should try that again. Forecasting should be an ongoing part of monitoring the business. And what this diagram is showing is any forecast. The vertical axis is first of all, the accuracy of the forecast. The horizontal axis is the timeline out in the future. Start with the first line. Any forecast will become less accurate compared to the actual 1 day, 1 week, 1 month, after you basically produce the forecast. So refresh the forecast quarterly, maybe even monthly. And since if this is, let's say, the forecast for a commercial company, the sales volume and mix, then each time the sales function and the marketing function reforecasts the forecast, and they're having to do that for production planning, something I hadn't mentioned. I'm also what's called CPIM, Certified in Production and Inventory Management, with the American Production and Inventory Control Society, APICS, which has been rebranded ASCM, Association of Supply Chain Management. And so the forecast cast from the volume and mix from the sales department is needed for the production people or even the service level people in insurance companies and banks for their capacity management. And I'll talk about capacity management. So the point here is keep reforecasting, run it through that multi-level diagram that was like 2 or 3 slides earlier. It'll give you that pro forma income statement and balance sheet. It's a rolling financial forecast. A benefit, a bonus is then the board of directors can get net cash flow. You can know about financing the future if needed, or if there is cases of surplus cash. So the way to think about rolling financial forecasts is, here we've got the 12 months of the year. At the very end is what I call the wall, end of the year. So after January and February, refresh the forecast. Now we basically have a new rolling financial forecast for the next 10 months. Third line, there we are all the way January, February, March, April, May. Now we forecast, June through the end of the year, all the way to the end of the wall. But don't stop at the end of the wall. Go out maybe 18 months, maybe even 24 months, so you can really get a future view. Now we've got to put our industrial engineering hats on. We got to deal with resource capacity planning. So a little bit about capacity. Capacity only exists as resources. In that ABC model with I had the 3 modules, resources at the top, activities and processes in the middle, final cost objects at the bottom. Capacity doesn't exist in the bottom 2 modules. It's only at the top. It's, number of people and machines now, or assets. I'll read this text. In the very short term, you would not fire employees on a Tuesday due to a low workload in the house, but hire them back on Wednesday, when the workload's increased. But in the future, you may replace full-time employees with contractors or temporary workers, or you might lease assets that you might have purchased. So in this way, so-called fixed costs start becoming and behaving variably. So to show you the diagram at the bottom, the horizontal axis is the planning time horizon, from today, short term, to the right, out days, weeks, months, years. The vertical axis is the magnitude of the effort level to adjust capacities. So you'll notice that the very short term, as I just described, it's really difficult. You can't add a machine today, remove a machine tomorrow. But as we start moving weeks, months, years, as I provided the example, we may replace some full-time employees with contractors, temporary workers. We may lease assets that we would have purchased, which would have made them, moving them from being fixed to being variable. And in the long run, it's really easy. When a company goes bankrupt, even the CEO's job became variable. They're gone. So what's needed is you got to think like an industrial engineer. What this diagram is showing is when we look at the historical view, remember the ABC module, the spending's known, we calculate the product, the processes, the activities that belong to them, and then we reassign and trace on cause and effect relationships, the product, standard service lines, channels, and customers. It's basically costing. It's really used for strategic purposes. But when we go to the right, the predictive view through the windshield, not through the rear view mirror to the left, this is where we then have to classify the behavior of the resources as sunk, fixed, step fixed, or variable. And you'll notice I've got that horizontal, or I've got the line, the ascending line that's representative of what I described in the previous slide. The classification of the resources as fixed or variable depends on the planning horizon. As we go out, it's less fixed and more variable. Step fixed, just in case you're interested in what that means, resources come in discontinuous amounts. You can't buy half a machine. You can't hire a third of an employee. It's all or nothing. So they come in what are called step. They are step fixed. Now, the classification of the resources depends not only on the planning horizon, but on something else, the type of decision that's being made. Let me describe that with using this next slide. Because effectively what we're moving towards here is what's called marginal and incremental expense analysis. Because when you're doing future decisions, you do not include sunk or fixed expenses because they're not impacted. As I write here, most savvy managers know that some expenses are fixed short-term and variable long-term. They want to know the financial impact of a decision, which means they don't want you to include any of the sunk or fixed expenses. They only want to know the variable. Examples of these types of decisions are adding or dropping products, channels, or customers. Here, let's go back to customer profitability. I didn't describe that in much detail when I was describing the ABC. You may have heard me mention it. That's really where many are using activity-based costing. They're not stopping at the product gross profit margin line. They're going below that line, including marketing expenses, distribution channel expenses, sales expenses, customer service expenses. They're creating a profit and loss statement for each customer. And it's always shocking because people think, oh, our largest sales customer must automatically be our most profitable customer. No, typically the largest customers basically are high maintenance customers. They're difficult. They're always changing delivery schedule. They're never buying standard, only buying special. They're always calling help desk, always returning goods. That extra work means they're causing you a lot more money compared to low maintenance customers. We love them. Never change schedule, never call help desk, only buy standard, never return goods. If those two types of customers extreme, but the same volume, same mix, they're not equally profitable. So the message there is sales volume is not representative of profitability. So now let's say we have a very unprofitable customer. We decide to drop that customer. Okay, that's great. Customer goes away, but the sales goes away, but not necessarily the capacity. So it's freeing up unused capacity. And then we got to deal with what do we do with that unused capacity? Do we terminate people or do we fill it with more profitable business? Let's continue with the other examples. Make versus buy decisions, outsourcing or not outsourcing decisions, capital investment justification, and then the budgeting and rolling financial forecasts that I just described. So let me give you why I said the second factor of why the dependency of how you classify resources depends on the type of decision. What I have on the left, I've reversed the sequence of capacity from sunk at the bottom to fixed, up to step fixed, up to variable. So let's imagine that a very large customer of yours phones you up and says, I'm going to place a one-time large order with you, but here's my price, and I am not budging. Do you accept or reject the order? Well, if their price that they basically demand is $1 more than your variable expense, accept the order. You made a buck. But if they phone you the next day and say, I think we're going to repeat this order for the next 11 months, now you got to start thinking, wait a second, I may have to add some capacity, so I've got to include more. When you get to large capital expenditures at the right, you really almost have to include all of them. Basically, it's microengineering. It's microeconomics. I should have said microeconomics. You've got to think like an engineer. So how does this capacity planning work? What we have here is three phases. we start at the left. That's the requirements analysis. That's really the capacity requirements analysis. Then at the top, we do the capacity analysis. And then to the right, we will do a pro forma of, after we've made the decisions, what will the future projected expenses and P&L look like? So we start at the bottom left, product, service, demand. We want to get the work activity requirements. That'll give us to the resource requirements. When we get to the top, because the change of volume and mix will probably result in, well, that means we'll have too many employees that we don't need because the shift went away, and not enough employees that we do need. So we may have to remove some employees. We have to add employees. Ideally, personally, which human resources would get involved? It'd be stupid to fire some employees and then hire others. Why not cross-train the ones that are basically have less load so that they can pick up the right load? And then once we have that capacity plan, we do our pro forma. Let me take you through what I just described in a little bit more detail. And if you want to know more about this, this is actually comes from what's called a capacity planning model from a professional society called CAMI. You can see the source in the upper right. It's the Consortium of Advanced Management International. So to the left are going to be operational adjustments. To the right, we're going to have financial adjustments. So let me walk you through this. We'll start at the bottom left. We've got our strategic plan. That gives us our forecast. Once we have our forecast, we can then basically the volume and mix of the products and services. Then we basically get to our rates. Then our rates have the capacity. If the executives want a better number, our first adjustment is the physical capacity. Add more people, remove people. Second is those productivity process improvements. Remember, Toyota, General Motors, Chrysler, 2%, 4%. We adjust the consumption rates. To the right, the financial adjustments. If we want to make more money, we could increase price, but there's always a risk when you increase price. You know, consumers and customers have price elasticity. They may go to a competitor. And number 5 at the upper right, you could adjust the resource expenses, basically negotiate lower prices with your suppliers. Or, in some cases during the COVID, you may actually ask employees, can you take a salary reduction, a wage reduction, 5%, 10%? And I have a whole story on that I experienced that where we did actually take a cut, but our CEO promised when we get back on track, they would return it. So let me show you a diagram that starts putting all of what I've described into a picture. I created this taxonomy for an organization called the International Federation of Accountants. Their website is ifac.org. International Federation of Accountants, they're in New York City, is like the United Nations of global accounting institutes. I think there's about 180 or more global institutes. Examples in the US would be the AICPA, which is actually here in Durham, North Carolina. I actually visit them. They're a 20-minute drive down the road from here. CIMA, Chartered Institute of Management Accountants in the UK, Institute of Management Accountants, that I described. So how does this taxonomy work? Taxonomy is like in biology, plant kingdoms, animal kingdoms. Well, in this diagram at the top, there's the 3 kingdoms of accounting: tax accounting, financial accounting, managerial accounting. Now, the source data that goes into accounting is captured from, the ledger systems and, from production systems. So let's start with the managerial accounting, the white box. And look down, it's got cost measurement. I need to clarify something. Expenses and costs are not the same thing. Expenses are when the organization exchanges money with third parties or pays employees. Currency exits the treasury, like writing a check. All costs are calculated. An activity cost, a process cost, a product cost, and so forth. Now notice from that box, cost measurement to the left goes into the financial accounting. That's the external statutory reporting. And when they do that, they follow something called generally accepted accounting principle. the acronym GAAP. The nickname is GAAP. So that's when the accountants are producing reports for, the IRS or and so forth. But for management accounting, it's cost reporting and analysis. We don't have to follow those rules. We're modeling things. We'll change some of the assumptions and so forth. And that gives us things like, variance analysis, profitability reporting, cost of quality. If you want to know more about cost of quality, I'm also involved with the American Society of Quality. But that's the historical view. Look to the right. There's our predictive view, decision support, cost planning, incremental marginal expense analysis, driver-based budgeting and rolling financial forecast. What if scenarios, changing forecast volume and mix, let's increase it 5%, see what the impact is on the P&L. Let's decrease it 5%. Product channel customer rationalization. That rationalization, should we drop or abandon a product or customer? Should we add new ones? Outsourcing, make versus buy. I want to tell you, when I present to the CPAs, some of them don't particularly care for me, Gary Cokins. Why? Because at the bottom, I've got what I call the value spectrum. Notice to the far left, low value add. As we move to the middle, modest value add. We go to the right, high value add. What this diagram is saying is, look, the value of accounting increases as we go from left to right. But many of the CPAs, when I'm presenting at their state CPA, they're just doing the financial external compliance reporting. So I've pretty much insulted them, saying what you do is low value add. The real value comes as you move to the right. So how do we put it all together? This is a diagram of enterprise performance or corporate performance management. I'll describe it in a second. Think of it like a circulatory system, like your heart and your blood, if you will. The big box organizational resource is your company's employees and your assets. I want to make a point here, though. Customer loyalty at the top. Notice the arrow. It says we want to connect customer value creation to shareholder or owner value creation. The message there is customers are the source of value creation for wealth creation of shareholders and owners. That's why the CFO and the accountants really need to produce profit and loss statements by each customer so that they can see how much money do we make with our customers. Okay, how does this diagram work? And I'm going to show you, I'm going to decompose it in the next few slides. We start with the customer loyalty. We move to the left. The executives will formulate strategy typically based on customer. Yes, I know some of you have MBAs and you'll say Michael Porter, 5 forces, we can include that. They will then communicate the strategy to the employees with the balanced scorecard and dashboards. And then that basically provides the feedback to the employees in the organization. When we go up, the CRM stands for Customer Relationship Management. Now, we're basically asking the question, which types of customers are most attractive to retain, to grow, to win back and acquire? Which types are not attractive? How much we optimally spend? Now you see the counterclockwise arrow there. That's basically the area of lean management, Six Sigma, enterprise resource planning systems. Take the customer order, complete the order, admit the hospital patient, heal the patient. The most universal end-to-end process is order fulfillment. It's universal. So where's management accounting and analytics in my diagram? I didn't put it in there. Why? Because the output of management accounting and analytics is pervasive. It's the input everywhere, cumulatively. One of my books on the activity-based costing, cost management, and executive guide, I have a appendix at the back. I describe 131 different types of decisions that are used with management accounting. So let's revisit how the diagram works. We start with the customer satisfaction. Notice their needs is how the executives will formulate the strategy. Strategy will then be communicated to the employees with the dashboards and scorecards that provides the feedback. Just imagine if every employee every day could answer this one question: how am I doing on what is important? How am I doing on what is important? Well, the strategy map and balance scorecard helps answer the first question: how am I doing? They turn on their computer in the morning, they look at 3 dials of their KPIs. Is the dial favorable or unfavorable to the target? The real key is the second half of the question, on what's important. And I didn't talk about it in this webinar, but if you're interested in another rapid prototyping workshop that I can share with you, it can build a strategy map in 1 day and the KPIs in 1 day, not 3 weeks. It's a whole story how to do that. But when every employee can answer the question, how are we doing on what's important, then it's how are we doing on what's important. Then comes the targeting. Which type of customer is most attractive to retain, grow, win back, and acquire? Which type's not? Process improvement. And because there is not animation in the platform I'm using here, you see those little white dots. They are in with animation. They are all flowing. They're flowing like veins in your blood, okay? And that's happening every minute, hour, day, week, month, year. And the tribute to the executives, though, because some of those veins may be constricted. I call it arterial sclerosis of the EPM system. So when they're restricted, it's really up to the executives to widen them. So, because if we don't, notice, look, the money doesn't go all the way to the shareholders, it leaks into the sewer. So to the degree we've got inefficient processes, waste, poor targeting of customers, unprofitable customers, we don't get all of the money. So to start summarizing here, what's really happening is there is a shift in the return on investment for organizations from tangible assets to intangible assets. And what I mean by that is the shift is from the ROI from purchasing investments like trucks or machines or computer hardware, computer software, to an intangible asset like information. And you'll notice in this diagram that the return on investment from information from left to right increases exponentially as we go from data to information to knowledge to insights to decisions. The problem is many organizations are stuck in only the first 2 red bubbles to the left. All they've got is raw data and standard reports. All that they can answer is what happened. Now, in some cases, the IT department, maybe some of you who are listening to me, are providing some of your managers, with drill down software, examples, Click, Tableau, Microsoft Power BI, SAS, my previous employer, so that the managers can drill down to maybe, a line item of an invoice or a purchase order. They can look at anomalies, the acronym OLAP, Online Analytical Processing. But they're still restricted even there with only answering what happened. Once we start with enterprise performance management and ABC and all these methods, we now get to descriptive modeling. Costing is modeling. Remember that strategy map with all those strategic objectives? That was the executive team's strategy, a picture on a single page. And once we're at that first blue bubble, we not only know what happened, we know why did it happen. Why do we have why? Because we're using causality. We must comply with the causality principle. But that's still looking through the rear view mirror. Next step, predictive modeling, which is what this webinar was about. The future view. Not only driver-based rolling financial forecast, what if scenarios, make versus buy decisions, capital budgeting. Once we're at that bubble, we not only know what happened, why did it happen, what can happen, what are all the options. And if some of you are following what's going on in the data science area, I used to think predictive modeling, in fact, one of my books you may remember from my bio page at the very beginning, was Predictive Business Analytics. I co-authored it with Larry Maisel, a KPMG partner. When we wrote it, I went, oh, well, that's Mount Everest. That's as high as you can go. And then prescriptive analytics kind of came into space. It's really code for optimization. When you're at that highest level, you can answer not only what happened, why did it happen, what can happen, but what's the best choice of what can happen, optimization. So as I start concluding, here's my frustration. What is taking so long? And I want to talk about resistance to change and more. Also, very briefly, remember IFAC, National Federation of Accountants? I did create another paper for them that is a stages of maturity assessment. I'm not going to go through it long. I'm going to show you in the next slide. If you're interested in it, or to give it to your CFO or your accountants, the link to get to it is at the right. Very briefly, it's got 8 stages of maturity for the historical view. It's got 5 stages of maturity for the predictive view. I just want to briefly tell you, 95% of organizations are in a 5D or lower in the historical view. They're just doing that butter spreading of cost allocations. And notice to the right, 1P is that spreadsheets up, down, up, down, up, down. And as we go to the right, it's the methods that I was describing to you here. The reason this could be of value is because your own organization could self-assess what stage are you at. And if you're and because most are going to be a 5D, the real challenge is, what do we do to get to a 6D and then to a 7D? And you can get there through rapid prototyping. So my frustration, why is the adoption rate for driver-based budgeting and enterprise performance methods so slow? Whoop. Well, here's part of the problem. I love this cartoon. The vertical axis is the mathematical skill you acquire over your life. The horizontal axis is what stage of life, kindergarten, 5th grade, we start with, basic, 4 notches in a line across it. Then, addition, subtraction, multiplication, division. Oh, now we must be in junior high, geometry, up to algebra, trigonomic, we must be at college by now, calculus, advanced calculus. And then what happens when they get in their job, the accountants, right back to spreadsheets. But there's some other bigger obstacles. The IT department and users have common goals. Both sides want to make better decisions. Both want to optimize performance and manage risk. Both sides want to achieve strategic objectives. But as you know well, since I'm going to presume that the majority of you listening to me, if all of you are from the IT function and not the user or the information function, your IT systems evolve organically and sometimes erratically. And sometimes it's a challenge for the users because of this. So I'm going to make an observation that there is a big brick wall between the users and you to the left, IT. This wall's got to come down. This is the way I view what's on other side of the wall. For you, IT, it's a set of technologies. You are the gatekeepers of the data, your daily operations, keep the lights on, batch processing, data storage, data structures, data governance, all good. To the right side, what the users want, things like employees, like in the accounting department, financial planning and analysis, FP&A, even marketing, supply chain managers, they want an analytical sandbox. They want a set of capabilities, discovery, investigation, and analysis. But here's the problem. Each side views the other differently. On your side, you might look at your users as a competitor. Oh, you went out and bought some of that drill down software because the price was below the approval level of your manager and you didn't tell us about it. And we've got our whole, if you will, IT, platform plan. Okay, you solve problems, but you don't operate the hardware and software like we do. Also, you can be resource intensive. Also, you're risky. 3 of you, not knowing it, came in and crashed our customer master file. And it took us 24 hours to basically restore the customer master file. You don't have any appreciation for governance control. Also, You're a mystery. I'm not sure what you really do over there. All right. How do the users view you? You're obstructionists. You're controlling. You're uncooperative. You're bureaucrats. Oh, I basically want to change the computer program. And you say, all right, fill out the form. I'll get to it in a couple of months. You're less skilled than us. Yeah, you're technical, but we got MBAs over here. You're just a service center. I know I'm being dramatic here. I'm deliberately trying to be dramatic. The point is, we've got to break that wall down. Business analytics provides IT the opportunity to drive value, but IT will need to be a little more tolerant and flexible. But there's some other barriers that are slowing. And I'll describe these three. The first one is there's the barriers that are slowing the adoption rate. There are the technical barriers. We'll start with dirty data, low quality data. But fortunately, you in the IT world have extraction, transform, and load. You've got ETL tools that can purify the data. For larger companies, it could be hardware issues. You could have multiple hardware. You got Dell equipment, you got IBM equipment, you got Hewlett Packard equipment. IT can solve number one. The next barrier is the perception barrier of excess complexity and affordability. And I think I've already demonstrated to you, especially for the CFOs who all think, oh, IBC, it'll take 6 months to implement 3,000 activities, that you can have a fully permanent, repeatable ABC production system in 3 weeks, not 6 months. And same thing with the strategy map and balance scorecard. But the real problem, the biggest obstacle, is not one or two. It's got nothing to do with software. It's got nothing to do with technology. It's all about people. It's organizational behavior barriers. It involves resistance to change, culture, and leadership. Let's start with resistance to change. It's human nature. People like the status quo. People do not like change. Only babies like change, with diapers. Also, fear of being measured, fear of being held accountable, or, just fear of others knowing the truth. I don't want other people to know what the costs are in my department. Weak leadership. There, I said it. Not every executive team's got the highest IQ. So the message here really for the users to overcome, and actually this can apply to IT as well, to overcome resistance to change, you've got to have some change management skills. But if I saw you raise your hands, how many of you have degrees in psychology or sociology? Probably none, or maybe one or two. You need to have some of those skills. Most of us are all what I call Newtonians, like Isaac Newton. To us, the world's a big machine. Give me the levers, the pulleys, the dials. We need to be somewhat like, Charles Darwin, Darwinian, sense and respond. It's an organism. Here's a bunch of excuses why people are not progressive. We are profitable, so why does it matter? Well, you may not be profitable forever. We will purchase software that will fix our problem. Yeah, a fool with a tool is still a fool. Software basically is an enabler. We already know our true costs from our general ledger financial accounting systems. No, those accountants, they know their true expenses. They don't know their costs. They got to calculate the cost. We have done it this way forever. We don't do that here. We already know everything. It's in our heads. Pretty arrogant. We are a small organization. We'll worry about better methods when we get larger. Well, guess what? You may not get larger. You may be bankrupt before that happens. All this hype is just made up stuff from highly paid consultants. Well, let me defend the consultants. Consultants can do something you can't do, the ability to focus. When they have a consulting engagement, they've got deliverables. Next, no one looks at the reports I create, so there is no point generating better reports. That's sad. The person is actually trying to help out their line managers, giving them better information. They throw the report into the trash can. We cannot afford better software to fix our problems. You'd be surprised, some of the activity-based costing software vendors' prices pretty low. We are way too busy doing other things. One of those things is closing the books. This is back to the accountants. They spend 3.5 weeks closing the books. They take a deep breath, and the next month's hamster cycle starts again. They need to close the books in a couple of weeks so they've got the time to implement these methods. We don't know where to start or how to get started. Well, I've already showed you, start with activity-based costing, or start with rapid prototyping. Here are two pictures. The left picture is the cover of one of my books. Got greasy, grimy, broken gears. The right side, titanium gears, rotating faster, if you will, revolutions per minute. That's where we want to get to. That's the vision. Wheels spinning, better, faster, cheaper, process improvement, safer, bringing in risk management, smarter. So action steps, get educated, get buy-in. That's the behavioral stuff. Rapid prototyping, start small, think big. And you're going to have to think about incentives. I don't have great skills in motivational theory. I have 3 links there, information and we're almost near the end. I mentioned there wasn't going to be, I'm going to hand it back to Susan in just, I think, a minute here. If you have questions, directly email them to me. Also, notice at the bottom left, Copyright 2020, that's my website. If you go to my tabs in my website, there are free downloadable articles I've written. No, you don't have to pay for anything. There also is a contact me that you can get to me there. So your success depends on how well and how fast the right information intelligence gets to the right people. There's my email address.
Cary, we thank you so much for your time and for presenting with us today.
My pleasure.